how's it going, guys? Welcome back to the Capital Mindset Show. Today, we're going to be talking about Starbucks. All right. So Starbucks have been making the news lately because we got this guy coming back in. We got Howard Schultz. So Howard Schultz originally had left the company several times. He had stepped down officially when I think it was 2017. And actually, we'll actually get to the crux of why that's very important. So this video is going to serve as a case study as well as an exploration to see whether or not Starbucks is a good addition at some point to our portfolio. So Starbucks is a coffee chain. We all know that. And it's one of the largest, if not the largest coffee chain in the entire world. I think if you exclude McDonald's, because McDonald's serves coffee as well. So, but as an exclusive coffee chain, I think Starbucks is the largest. And actually, we'll take a look at the share price and we'll begin with that first. So taking a look right here, we have the performance not too good today. It's down 4.1%. We take a look at the 1 year, it is down 23%. Now, taking a look at the 5 year, we will see some performance, some good performance, 45% up. But of course, it's down from those all-time highs. Now, we know that Howard Schultz stepped down officially around 2017. And that's going to be very important for what we're going to discuss here today, right? We're going to look at a company that had a shift in strategy, right? And we had this other guy, right? We had Johnson, right? Kevin Johnson. Kevin Johnson is the CEO that stepped down, and he came onto the position around 2017, and then he just recently had stepped down in favor of Howard Schultz coming back on. So Howard Schultz has been with this company forever at this point. He is what we can consider the founder of Starbucks. So him coming back on is, I think, a good sign for us as investors if we are invested, because we have an owner back in the hands or at the wheel, right? And we'll actually get into, I think, why he came back. So let's actually skip over and get to that point. So right here, I want to highlight something to you. Look at the long-term debt. Long-term debt is 14 billion to 13 billion. That's where we are now. So about 14 billion right now, 13.6 to be exact. And why is this important? Well, if we take a look at this, right, this is the 2017 numbers. I want you guys to take a look down at the long-term debt. So we go to long-term debt right here, and we follow the line item, 3.9 billion back in 2017 when Howard Schultz left the company. What happened? All right. Well, it's pretty simple to explain that. Share buybacks, right? So the company under, I always forget his name, Johnson, I'll just call him Johnson from here on out, Kevin Johnson, he came on and he initiated a massive buyback program in order to buy back shares of Starbucks, right? Well, in consequence, what happened was value destruction on the balance sheet, right? Not total value destruction, because some people are going to say, well, hey, look at the stock price ever since it went up. However, from a long-term investment standpoint, I don't like to see accumulation of debt in an effort to boost stock price. And this is what happened. Okay, objectively, I think that's exactly what happened. The CEO who came in pursued a strategy of leveraging up the balance sheet in order to repurchase shares. And remember, we've had a discussion on the efficacy of buybacks versus dividends and how there's a specific caveat to when you would say that buybacks are better. And reasoning why you'd have to really trust management is that buybacks have to be executed properly. If not, they can be very destructive to the long-term value of a business. We can see a la IBM, right? In this case, Starbucks hasn't had that same level of value destruction because, if we're being honest, the amount of debt accumulated isn't something that would cripple the business. So it's not terrible. However, we can see how was the different managing styles between Howard Schultz and Johnson. Okay, so Johnson is a little bit more aggressive on that balance sheet. Howard Schultz acts more like an owner. He wants to preserve the long-term value of the business of that balance sheet. So we know that, for example, right here, I just wanted to pull this up. So we know that Howard Schultz has been in and out of the company. He always comes back and then he seems to fix the company up and then he leaves. So I think this is another instance of he comes back here, he's going to fix up the company and then probably leave again. Or maybe he stays with the company for the rest of his life. We don't know that. So let's actually go into the model and see what we can pull up of Starbucks. Okay, let's I bet you analysts are kind of bullish on this, if I had to guess. Okay, so analysts are neutral. All right, so I'm wrong on that. And this is to show I haven't seen this yet. So we're going to be looking at this raw together. Price target of 116.92 cents, applying a 38.38% upside. All right, return on invested capital is really strong, right? That picks up immediately. Return on equity, negative 79%. They probably have a negative equity balance. PE of 23, price free cash flow of 21 on the expensive side, just on a quick glance. Growth isn't that high. You can see here that they've been doing a ton of buybacks. And this is the important note to say, right? What has Howard Schultz done as soon as he steps in? Well, he's eliminated the buyback program, because what was the company doing, right? And this is, again, the lessons of this case study. What was the company doing? The company was focusing on taking debt, right? Taking on debt and then shoving that in, buying back shares, right? And in an effort to boost the stock price, instead of doing what, right? What did Howard Schultz say that he's going to do from here on out? Well, he says he's going to reinvest it into the business instead of focusing on share repurchases. Well, what is he implying by that? Well, that implies that the company hasn't made the necessary investments into their coffee chain, into their business. And this is kind of a negative or a stain on the previous CEO. It shows me that the other CEO didn't think like an owner. And then we get down to kind of another lesson or another part of the case study that we're going to discuss here today. And it goes to show the difference between a company being run by an owner and a company being run by a manager, right? Johnson is a manager. Howard Schultz is an owner. He's like what Warren Buffett idealizes in terms of who you want at the helm of a company. Someone who doesn't care about what the share price is doing in 1 to 5 years. He looks at the longer term, the 10-year mark. You're an owner of a business. You're not a trader. You're not buying this piece of paper and that the price go up and you sell it. No, he's in it for his wealth to grow over long periods of time. So if I wanted to sell a company to you, what I would probably try to do, and if I was a little bit nefarious, I would leverage up the balance sheet a little bit, right? Now, that may or may not affect your valuation of the business, right? But if I could leverage up the balance sheet, it appears as though it is a company that was prepared to be sold in an aspect, not literally. Okay, so in this instance, it's not a literal preparation to be sold. No one's buying Starbucks. Okay, and there's no acquisition or anything like that. But it's as if the previous CEO wanted an out, just wanted to, in essence, get their stock options. So in that aspect, that was the best return on investment that they could have done for themselves. Now, Howard Schultz has a significant portion of his net worth in this company. Well, what is his incentive going forward? It's not to leverage up the balance sheet and increase the share price now. It is to preserve the longevity of Starbucks. And so that 20 years down the road, his net worth is greater than it is now and sustainable, right? I bet you Howard Schultz lives off of that nice dividend, right? The amount of shares that he owns is enough that he could quite easily live off of those dividends. So he doesn't really care about the share buybacks per se or the boosting of the stock price. He wants the Starbucks shares for the rest of his life. Now, he might change that, but we don't know. So let's take a look back at the model. And we can see what's going on here. So, all right, so we have Starbucks growth. We're not doing buybacks, so we're going to do a 0% buyback because we know they're not going to do buybacks. Let's assume Howard Schultz says no buybacks. We're not doing any buybacks. We're going to reinvest into the business. Let's see how they're priced right now. So let's start with the 12% discount rate. And let's start with some growth rates. So I think that they can grow probably between, let's say, 10% on the high end, and 6% in the middle, and on the low end, 2%. So then let's do 4%. That's fine. And then 7%. Okay, so what we can see here is that with a low discount rate, not a high margin of safety, we're not in the buy zone whatsoever. It appears so that the buybacks are what is producing value based on the valuations of today. Now, let's take a look down at the sales to make sure nothing crazy is going on. Okay, so we see that they are basically recovered. We saw that little dip during the pandemic, and then analysts have an estimate of growth quite nicely, actually. Cash flow, similar story here. They estimate growth, and then we see that the shares outstanding has come down. I don't think they're going to dilute. I also don't think they're going to focus on buybacks. Let's take a look at the earnings transcript. No, let's take a look at what the titles are saying of these. Okay, why storm sliding? Okay, so a lot of people are talking about it sliding today. And then mentions, we have Twitter, mentions on Twitter, sentiment score is fairly positive. Okay, so that's good. Let's take a look at these ratios, and let's take a look at the longer period. Okay, so liquidity ratios are pretty good, have come down a bit, but pretty good. I won't look at their cash ratio and judge them on that. It is improving though, and hopefully Howard Schultz can improve the balance sheet even further. Total debt ratio, we do see a deterioration quite drastically. This is what we're talking about. So this is the crux of the lesson today, everyone. It's the difference when different types of management take hold, and you might see short-term boosts, but I would be concerned about the longer term story of Starbucks. Now, I'm not so concerned now because I do think Howard Schultz is going to turn this business around for the better. They're going to actually focus on improving the operations of the business, focus on the consumer, focus on bringing down costs and staying competitive. They're going to make the necessary investments. We also know that Starbucks had recently lost a battle for unions or whatever. I personally, my opinion, if you want to know my opinion, but disregard it if you don't, and then just skip over this part. My opinion on the whole union shenanigans is that over the longer term, it does not matter. Right? Whether or not that causes a short-term blip for the business is irrelevant. Either way, the consumer will bear the brunt of the union. So if the union makes it more expensive for the business to do business in the particular area, that will be passed on to the consumer. Or if the business looks to alleviate itself from those burdens and try to, because at the end of the day, the burden will be passed to the consumer. So when they're alleviating the burden, they're alleviating me as the consumer. So I want my coffee. And if I can pay a lower price for that coffee, I would prefer to do that because I would rather, improve my own living standards. And I think that's a general consensus of every person. Every person wants to improve their living standards. So that includes not spending as much for the same products and for the same quality of products. So then we get into the crux of it. Starbucks over the next 10 years, I think, and I know, will be investing in improving operations within the business, perhaps making operations more efficient, less need for labor on hand. And this is not to say that I'm one of those people that think everyone's going to be replaced by robots. I think that conversation is a little bit nuanced. I'll say that my wife works very closely in that industry. And I won't say what company or anything like that, just to keep it private, but my family, my nuclear family, has a very good understanding of that industry. One day I might talk about it, but I wouldn't consider myself the expert, but I consider her more along the lines of that expertise. And what I would say is that the shift in terms of skill will be more in line with those who work in that industry. So it basically creates different types of jobs. It's not that it eliminates jobs entirely, is what I'm trying to say there. And then we've seen stuff like this in history happen before. I'll say this, until robotics achieves sentiency, which implies the ability to imagine. And again, this is the opinion that you can disregard, this whole thing. Until that happens, we won't have anything to really worry about to the same extent as I call them like neo-Malthists. Every time I hear someone's like a doomsayer, I just call them neo-Malthists. For those of you who don't know the historical context, there was an individual named by Thomas Malthus, who was back in the day saying that there was overpopulation and a big problem, and he couldn't perceive or conceive the adaptation or changes in the economy. And then there's a lot of neo-Malthus philosophies today. I won't get into it, but there's just a lot of them today. And I think one of those is everyone will be replaced by robots like next year. It's like, no. When they achieve sentiency, perhaps. So DuPont analysis looks pretty good. Oh, we're over the opinion, so we're going back to the statistics. DuPont analysis looks pretty good. Gross profit margin, though, that's a negative sign. I'm assuming, no, not I'm assuming, I know that it's reduced so drastically because they went from a franchise model to corporate owned model. So remember, in finance and investing, we don't want to just stare at numbers and just go, oh, numbers, go down. No, we want to derive a story from the numbers. And this is very important. This will be a heavy focus when I eventually release the finance portion of the course. That, again, for those of you who are new to the channel, I'll release a course that's pay what you want. But that will be a heavy focus of trying to show people how to derive a story from the numbers and not just look at numbers. So the numbers are telling me something. Something occurred for the margins to go from 57 to 28 over this time period. Well, simply put, that's going from franchise high margin model, which is what McDonald's is actually going more towards, and instead going to more corporate owned, corporate controlled model where the liability is held by the corporation and not the individual franchisees. Okay, they may in fact opt to do the other way if unionization becomes a big problem and kind of decentralize the workforce in an effort to kind of alleviate those liabilities. That might be a strategy that they pursue. I actually won't be surprised if they end up doing that, but that's just conjecture. I don't know for sure. So net profit margin, this has improved, okay? And then ROA, ROE, pretty good on the ROA. ROE is probably negative because they have negative equity at the present moment, but that's kind of a blip. Looking down at the ROIC, excellent, amazing, except for 2020, but that's a blip. Very good, consistently good. And then 2014, also a blip. Earnings quality is consistently good. 2013 is a blip. I ignore that, but we got to focus on the fact that most of the time, this is it's a really good, well-run business model, scoring it really nicely. All right, so going back to the summary report, I'm going to be looking at what price would I be interested in Starbucks. And to be honest, I'd be interested in Starbucks back in the 50s. If I can get this thing or start accumulating back in the $50 range, I think that we're game on. Because the thing is, if we're being honest, a lot of the value is derived from that buyback. Right. So if I say this and then I discount it a little bit more, you see that at $50-ish, I can assume even a 4%. Right. And that's assuming that going forward, they basically produce almost all those cash flows back to me in the form of buybacks or a dividend. Right. So I think that is possible later down the line as Starbucks kind of mushes through all these headwinds. We also have the China headwinds. And, this is the portion of the video where I focus and highlight all of the risks to this investment. And I think it's very important that we focus on the risks. So I'm not buying it now. I just want to be very clear. I'm not buying it now, but it is on the watch list and I'm going to be interested. And the price range right now that I'm penciling out is in the 50s, right? That would be the price range where I'd be interested in purchasing shares. I may purchase shares at a higher price just to accumulate a fantastic business at a fair or just okay price. But it won't be a sizable position by any stretch of the imagination. You guys see how I kind of operate the portfolio. Sometimes I buy a position earlier than where my buy prices or where I'd like to own it, simply because I don't exactly know if I will ever get that price, but it does dictate, it does have a huge impact on the position sizing. I won't make a position big or substantial unless it's in the prices where I like it, right? I do have to like the price where I buy it in the first place. It's not like I'll look at a stock and I'm like, oh, this is extremely overvalued and I'm just going to buy it anyway. No. So I don't want you guys to think that as well. All right, but let's get to the risks here. So the risk number one, right, I'd say is the overall macro environment. Starbucks is considered to be expensive for a lot of people, but I do think the counter argument to that is people will still pay for that coffee, even though it's expensive. It's their guilty pleasure. I myself don't buy it. My wife will go out to Starbucks and she might get herself a Starbucks. Maybe she'll be with my sister. She'll get her a Starbucks, or she'll even, go out with her mother and she'll get her a Starbucks. So it's more like a social event as well. She doesn't really get it by herself because we have a coffee machine here. We have like a proper coffee machine, like a very nice, and it's a massive upfront cost, but over time I don't spend much on coffee at all, and I can change up the roasts and all that. So I've been drinking more tea. You guys didn't ask for that, but I've been drinking more tea. I don't have a problem with coffee. Don't assume that. I'm just kidding. But we have those risks. We have the inventory risks with commodities, coffee commodities, etc. So, as Starbucks, you are heavily exposed to the commodity pricing of coffee that can affect your margins. We have union risks, we have labor risks, we have investments that need to be done, right? That's going to currently reduce the cash flows. We don't want to punish Starbucks too much for that. I want to warn everyone that the cash flows are going to drop a lot right now. So I don't agree with analyst estimates. I think analysts aren't actually updated, or those numbers that analysts say about the cash flows are not updated for what's about to happen with Howard Schultz. Howard Schultz has said they're going to invest a ton in the actual business. So because of that, I think you're going to see cash flows reduce quite drastically. But you don't want to punish the business necessarily for that, because that's growth CapEx. That's CapEx necessary for producing greater value in the future. So we want to be careful about that. We want to also make sure that China is not a risk. So China, there's a potential risk of, anything could happen there. It is an authoritarian state. At any moment, they could change the whims. And if you would say China won't shoot themselves in the foot, okay, I agree. But when has authoritarian states not made mistakes? Because, we get back to the philosophy of the enlightened king. Everything's great when you have the enlightened king. One guy at the top makes all the decisions, or just a couple people at the top make all the decisions. All well and good as long as they are enlightened kings. As soon as they're not enlightened kings, the problems become exacerbated. Okay, so when you have one guy making all the decisions, you better hope they're making the right decisions. So I think the other risks we want to actually talk about is more going back to the macro, short-term recession might actually present an interesting buying opportunity. I actually think that if we experience a short-term recession, which we see the yield curve is indicating that, we've been talking a while in this channel about the probabilities of it based off of energy prices, food prices, and how that squeezes the consumer, and how that will over time or in this short term kind of crush consumer spending, which is a big portion of the economy. And if that occurs, we might see a very good buying opportunity for Starbucks. So I would be putting this on my watch list, and based on those risks, I do think those are all short-term risks. They're not long-term risks. The only bigger long-term risk is something like China, because a huge part of the bullish thesis on Starbucks is that Chinese expansion. So I'd be a little bit more concerned if anything were to occur on that front. But on that note, guys, let me know down below if you guys have any questions. If you like this video, go ahead and feel free to leave a like. If you're not subscribed, go ahead and subscribe and come back to the channel, and we'll probably be covering a stock that you're interested in looking at. The next stock we're going to be covering either today or tomorrow, you'll see the video on it, is Twitter, because we just saw big news on Twitter. So those are time-sensitive stocks, and that's why they take precedence or priority. And we also have I think you guys are going to be seeing one soon on what is it? Wish stock, which is the case study. Yeah, that's the ones I can think of right now, but you'll definitely be tuned in for those stocks. All right. On that note, guys, I hope you guys have a great one. I'll see you guys on the next one. Bye.